Jigar Mistry of Buoyant Capital is now with us. Jigar, morning, and thanks so much for joining us today on CNBC TV18. The big question is, what do you do with the markets? Just purely going by IT earnings, as I said, it looks like all the good news, the possible EPS upgrades are perhaps already baked into the price. So that's not going to move the needle for individual names. On a big picture, what is the approach for the next few months? We've got the budget lined up as well.
Hello, Rima. Good morning. Thank you for inviting again. So let's sort of break it down into two parts. One is the market and then the question on IT. If I look at the years that have gone by, right, S&P 500 was up almost 28.7%, including dividends in 2021. And it has doubled over the past 3 years. This is the only 3-year doubling that you have seen since the tech bubble. And since sort of, 1938, this is in the 93rd percentile. So sort of lays the foundation on how things have, panned out globally. In India, we discussed last time around that in this millennium, there has never been a 7th consecutive year in which the market was up. We have already had 6 good years. In the previous millennium, between 1988 and 94, the market was up for the 7th year. But since that 7th year, the market took 5 years to come back to the same level. Fundamentals are different, liquidity conditions are very different, economy is very, very different. But one needs to sort of, lay the foundation on where things stack up as we enter 2022. And the return expectation, therefore, needs to be, tapered down in terms of what you are willing to do. And therefore, we think that, the sector selection is going to be far more important than stock selection, right? A good company in a bad sector will still be not enough when you compare a bad company in a good sector. And, over the last 20 years or so, we have had almost 10 cycles, 2004 to 7, you needed to just own any, consumer or capital goods company and not own FMCG. 2007 to 9, you didn't have to own a realty. You could have owned anything else. So I think 2022 will be one of those years where the sector selection will play a very large role, and it would more be a top-down investment approach rather than bottom-up. On to your question on IT, I think, you sort of hit it on the head. Within tech, we think that the rotation is happening. The deal sort of volume has moved to smaller deals. And therefore, the smaller companies have actually emerged to be a lot, better in terms of their reporting. Having said that, there are only a few of those businesses which are available at reasonable valuations, right? One of the companies that we own in that space is Buoyant. 33% of its revenue was, in aerospace and transportation before COVID. And when sort of the things reopen, we should see some of those businesses come back on. But Buoyant, Firstsource, HCL, I think those are the only 3 odd names which are in the 20 to 25%, 25 times forward earnings. The rest, everything has moved up, and you will need a bigger jolt, even bigger than what Infosys provided, in order for you to see a positive momentum there.
Jigar, hi, good morning. That's your take on some of the IT names and how you're approaching it. What about the rest of the market, and specifically financials, because that was always a talking point as we got into 2022, the underperformance in the Bank Nifty. Do you see that changing, and what part of financials are you looking to own?
This will be a momentous announcement, I must say. Congratulations for that.
Thank you.
One of the stocks I would still discuss is the one that I discussed in my first interview 4 years back with you and Prashant. Financial space is interesting, and so is insurance. In financials, I think what has happened is that we have had 5 or 6 years of proper consolidation where banks are having seen, very clean sort of book come through, and whatever disruptions we have had, 2016 demon, 2017 GST, 2018 NBFC crisis, 2020 and 21, I would add as pandemic. And now as they start focusing on growth with a controlled sort of book, I think the clear winner in this space is going to be banks. I've been saying that for a while now, but I think that also reflects in how we have been positioned. A lot of banks have moved up, but I think in 2022, we see an absolute upside in those names, the likes of ICICI, SBI, Federal Bank. Insurance again is very interesting, and that is, I think, the one stock that we discussed way back in 2019. It's come a long way, Max Financial, but as a sector, I think it is one of those fastest growing over 2-year, 3-year time frames when you compare it to pre-COVID level. Product mix is going from saving heavy ULIP to protection and traditional non-par, and all this can lead to higher margin, which is starting to be visible. So ROEVs have already gone from mid-teen to mid-20s, and Chinese insurance companies you have seen report even higher numbers. We like Max because although the valuation gap has been bridged vis-a-vis HDFC and SBI Life, it's still with the New York Life parentage as one of the very strong agency forces, and it trades about 2.6 times price to EV and 15 times price to VNB, which is, I think, in line with SBI, but still at a discount to HDFC. So that stock we have continued to own since we first spoke, but it still looks very interesting to us.
All right. Hi, Jigar. Good morning and thanks for joining us. This is Pavitra. You mentioned that this is a time when you look to sort of take out some positions rather than add positions. So you did mention the IT space, but where else do you think you would look to trim your positions? Because, and I know that we've also been speaking about this entire unlock trade, right through the pandemic, and ever since that recovery did start coming in. Do you think most of the gains are in for some of these unlock players?
Hello, Pavitra. Yes, good morning. I think some of the reopening themes have run up reasonably well, and we have taken some money off on something like, the beverage, alcohol beverage business, and also, hotels and etc. Although they look fairly good in terms of how they report numbers, but a lot of stocks have run up ahead of that. So that's one place which sounds a little bit cautious. Even chemicals, some of the chemical names have run up fairly well, and although you need to, and they've corrected. Say, to be fair, over the last 3 or 4 months, they've corrected reasonably well. Other than the fluorination chemistry, so SRF, which is on your screen, Navin Fluorine, and Gujarat Fluorochem is the company that we own. Those are the fluorination chemistry still looks reasonably well, but a large part of other chemical space which had run up because of the China plus one thesis needs to be sort of tapered down a little bit. Last part is commodities as well, and in the commodity space, we have had good years, and if you look at the 3Q numbers, we should arguably at the market level be showing very strong numbers. So 36% revenue growth, 22% PAT growth, but all of that is being sort of driven by banks, energy and commodity companies, and the lowest performers or the negative growth will be from the likes of Maruti, Airtel, Asian Paints and Bajaj Auto, and there you will see the intrinsic de-rating of the index itself being visible. Now when you juxtapose that to the fact that India is among the most expensive markets on historical PE terms as well as compared to the rest of the world, it should give you a sense that things are not going to be as cozy as they were in 2021.
Jigar, thank you very much for joining us. Look forward to chatting another time.